This video is brought to you by the letter P. P as in perspective. Hey, and welcome back to the channel. My name is Hans. This is my wife, Kristin, with the Gunderman Group at Keller Williams Luxury International. And today we wanted to bring you another market statistic update video, but more based on perspective, because it's really important in this changing market to understand how we got here so you can understand potentially what might change and thus affect the real estate market going forward.
So we're going to go through a few graphs that are going to draw your attention to some macroeconomic indicators that we're seeing historically. And then we'll also look at some of the more microeconomic activity that might impact your buying and selling choices here in the Bay Area real estate market.
All of this data was produced by Keller Williams worldwide, so you'll see the copyright there. That's where the data came from. They've got a disclaimer, so I'll throw that up here real quick. Just make sure you verify any of this information before you go make a decision relative to your personal situation.
So let's dive in first with this graph of GDP. So what you can see through this graph is that GDP quarterly since 2012 has stayed relatively stable until, of course, COVID hit. So what you'll see when COVID hit is that GDP went way down. And this, as everyone remembers, was largely due to the lockdowns and the contracting of the economy. But then stimulus programs and tax cuts came in, and we all saw a big lifestyle change where people started to spend more time at home and values were going up. And so consumers felt a little more confidence relative to the economy. So that's why you'll see that big upward trend right after the large downshift. But after both of these, what we've seen since is that we're back to levels that are slightly above what they were until the last couple of quarters, where we've seen them go down.
And when you layer that GDP growth or negative growth in some of these quarters on top of consumer confidence, what you get is this graph. It shows a really interesting, very stable perspective up until about the pandemic, and then we saw a dip and it came back up, and now it's at a pretty low level, lower than it's been in recent memory, frankly. And it's a very confusing graph when you consider the fact that jobs are really stable. Basically, everyone who wants a job can get one. The number of openings versus unemployment has never seen this big of a disparity. We have literally 2x the number of job openings as we did at the middle of the pandemic. Unemployment is back to pre-pandemic levels. So even though there's more job openings, even though there's more wage growth, there's more people earning bigger salaries, why is consumer confidence low? It has to do with affordability.
So that has to do with inflation. So what you can see on this graph is that inflation is higher than it's been all the way back to the 90s. And in fact, over the past handful of years, it's been quite low. So even though wages are higher and people are feeling like they're making more money, the goods that they are buying are costing more. So that's things like food and gas and rent, among other things. So even though people are feeling like they're making more money, they're also spending more money. And so that's the crux of all of this.
And when you also consider that the average American household holds somewhere between $4,000 to $6,000 in credit card debt at an average of about 21% interest, that's another like $1,200 a year of interest payments, because a lot of people are holding those balances. And you know, that plus the cost of gas and the cost of this and household goods, it's eating up any wage growth that they've experienced. And thus, they're basically in the same place and have lower confidence and don't want to spend as much. Obviously, when we're talking about housing, we're talking also about interest rates. We all know those are up. But look at the perspective of the historic averages here. When you look back to 1972, we are still well below that median line. Same thing, we're a little bit above since the early 90s, that average line. But to put things in perspective, the real estate world has gone through a lot of ebbs and flows in this course of this graph. And we're in an interest rate world right now that is somewhere between these two long-term averages. And so when you think about the recent history of interest rates and how that started to combat the affordability issue, it made things more affordable on a monthly payment basis. It made it easier to afford a bigger house or just a house in the first place. That has gone away. And so when you smash that together with inflation and credit card debt and some of these other household expenses, it becomes really, really hard to actually make that payment and then thus buy the house.
And so even though it feels like interest rates are so much higher than they have been over the past handful of years, and they are, if we look at the long-term historic average, they're still quite low relative to what they were in the past. So this is just a good thing to keep in mind. The other thing to think about relative to interest rates is the fact that it's not necessarily a great economic indicator that they stay low for many, 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 many years. It's healthy for the economy to go through these ebbs and flows. And even though interest rates are rising right now to combat inflation, that's not to say that they won't come down in the future at some point. So as this relates to the long-term prospect of purchasing a home and holding it over many years, it's just a reminder that these interest rates will most likely come back down at some point, and a refinance is certainly possible in the future.
If you want to check out our Q3 market update, we'll link to it up here, where we talked about marry the house, date the rate. So looking at the supply side of it, everyone wants to talk about price. House prices are up, they're so high, and yes, they are. We've not seen this type of double-digit increase annually really ever. If you look at the historic range of national real estate prices, you would expect an average range of 4% per year. And you can see this line indicates that 4% mark. And what we are seeing is since the last recession until 2021, we've been below that line. And so we're now finally catching up and slingshotting over that. That has to do with inventory, lack of inventory, but also relatively inexpensive borrowing rates, which goes back to the interest rate slide from earlier. But it also talks about new starts, new inventory that's coming in to the marketplace. When you look at the amount of construction, new single family home construction that's happened in this country, we have had a significant deficit since the last recession. The number of starts, 500,000, 600,000 are well below the 1 million per year average that we've needed to house all of the new household formation in this country. Our generation, millennials, are coming out, forming households, having kids, moving out of parents, people are buying second homes, etc. More rentals needed. All of that has just not happened. When you look at the confidence index for home builders, it's also been incredibly low because the cost to buy land, to finance these projects, to build them, to then sell them and make a profit, construction materials, etc., it's all been up. And so the likelihood that we see new construction starts show up in mass here in the at least near future is very unlikely. And so chances are you're going to see the inventory side of it lag. You're not going to see nearly as many new construction homes come on the market, and the existing home sales are down pretty significantly year over year as well.
So to bring all this together, really what we're looking at still is a supply and demand issue. In terms of the supply side of things, we are down, like Hans was just saying, relative to units that we have versus units that we need. And it doesn't look like there's going to be a huge injection of additional units in the next handful of years. On the demand side of things, demand certainly has been tamped down a bit due to interest rates coming up. However, this isn't totally out of whack for what we've seen on a historical base. So this is all just to say that, do we see this completely falling off a cliff relative to history? No, we don't. This is certainly very different than the market we've seen over the last handful of years, but if we zoom out a little bit, get a little perspective on all of this, what we're seeing is that this is not totally uncommon for our economy.
And so that's the perspective we were hoping to bring. Now, of course, all of this is subject to change with different things going on in Europe and China and so forth, plus elections and who knows what else. But based on historic figures and trends, we're still in line with a lot of those numbers, and the historic numbers, like lack of new construction starts, are supporting the fact that the supply will remain down, and thus the demand will still be forced to deal with a relatively limited number of homes, at least in the short term. To be determined long term. But I hope that this gave you some level of perspective about this market, about where we may be going, and obviously we will continue on this channel to report on any interesting things that we can bring that will hopefully help you in your real estate journey and your real estate success. So thanks for being here. If you got value out of this, hit the like button and subscribe to the channel because we'll continue to put out content just like this on a monthly basis. So thank you for being here, and we'll see you on the next one.